Hello and welcome back. We'll be looking at one of the key finance fundamentals, which we refer to as the WACC, the weighted average cost of capital. Under the intrinsic method of valuation, we'll look at one key concept, which is referred to as the DCF, the discounted cash flow method. So, what does the discounted cash flow method say? It basically says that look at the future cash flow that a company is able to generate, look at it, then discount it to the present value. Discount it. We want to know the worth as at today. That's basically what DCF is saying. So how do we get the discount rate that is in the DCF method of valuation? That's where the WACC comes in. That's where weighted average cost of capital comes in. A layman definition is basically the minimum rate of return or the minimum required rate of return that investors are willing to accept on their investment. That's the layman definition of that. So we are going to be looking at how to actually calculate these things and what's the composition of the formula basically. So we have the formula on the screen. We have the R debt, or what we refer to as the cost of debt. Then you net it off tax, which is 1 minus C. You look at the tax rate of the company income tax, multiply by your debt divided by debt plus equity. I'm going to be making a little bit of adjustments to the denominator in case we have preference share in the company. In case we have preference share. So if you have preference share in the company, so the denominator is going to change to debt plus equity plus preference share. Remember, a business is financed 2 ways or 3 ways as the case may be. You either have your debt or you have your equity. Most times, remember, your preference share has characteristic of both your debt and your equity, but still, it makes up the capital structure of the business. So we have that little modification in case we have preference share. Then we move on to the aspect of equity. So you have your R equity, which stands for your cost of equity multiplied by your equity divided by your debt plus equity. That's the formula. Now, how do we get all these line items that I've mentioned above? So we have your cost of debt. Your cost of debt is basically when you have a loan facilities, an obligation, the amount of interest you're paying on those loan facilities is going to serve as your cost of debt, basically. Then you do 1 minus T. Remember, I said your T is your company income tax or your tax rates, as the case may be. Then you add debt divided by your equity. Your equity, remember, look at the formula here. We have market value of equity. So your market value of equity is basically your share, your outstanding shares multiplied by the current market price. You're going to get your market value of equity. Then for your book value of debt, your book value of debt is basically the interest-bearing liabilities that we have in our books going to serve as our book value of debt. To get our equity, your cost of equity is basically calculated by using the CAPM method. What do I mean by the CAPM method? The capital asset pricing model. I'm going to do a video entirely on this aspect to explain how we come about this. So we have the risk-free, the risk-free here plus beta. We have a video on how to calculate beta minus your return on market minus your risk-free. This is basically your equity risk premium. What does your equity risk premium says? Oh, as an investor, I'm better off investing in an asset in a treasury bill of a particular government because I know the return is certain. So how the companies which have risk, how do they attract investors? They are going to offer what we call a premium. Typical example. Let's say the risk-free rate in Nigeria is around 14% assumption. Yeah. So an investor is not going to invest in a company that has risk at that 14%. It's going to require more than just that 14%. That's the equity risk premium that we are going to be offering. Then we have the beta, which actually measures the performance of the stock in relation to overall market. That's how we come about our cost of equity. Then we have equity as the numerator, the market value of equity. Then we add the debt plus equity, which is going to give us the addition of both is going to give us what we refer to as our WACC. Now we can use this WACC to actually infuse that in our DCF to discount our future cash flow down to the present value.